Good day, colleagues. My name is Thandiwe Malefo. I am an analyst from the Financial Advisories and Intermediaries Department at the FSCA, and I will be taking you through the conversation on financial soundness with my colleague Fortune Moreku, who is also an analyst at the FSCA in the same department. So today we'll be taking you through some of the new definitions that came in with the amendment of the fit and proper, as well as the requirements of Chapter 6, Financial Soundness Requirements. We will take you through the solvency calculation and how it is applied for FSPs that do not collect premiums. We will also take you through what is required for FSPs that collect premiums and the calculations that apply for FSPs that collect premiums as well. So on the Annexure 6A form, we will take you through the liquidity, how liquidity is calculated. And then lastly, we will take you through what happens to an FSP when a financial soundness exemption is granted and what is expected of you. The legislation that is applicable on this topic today is the Fais Act, Section 19, and Board Notice 194 of 2017, as amended by Board Notice 707 of 2020. We will particularly look at Chapter 6 of the Board Notice, which is sections 43 to 50, and particularly this Annexure 6 Form A that calculates the liquidity of FSPs that collect premiums. I will hand over to my colleague Fortune, who will take us through the FSPs that, the entities to whom this legislation applies to. Okay, over to you, Fortune.
Thank you, Thandiwe. I'm going to discuss this new requirements about who is affected by the financial soundness requirements that has been published. All financial services providers are affected, including the representative of the financial services providers. However, this does not include the key individual and representatives who are natural persons. In short, what we are saying is juristic representative of the financial services providers are affected by this new financial soundness requirements as per the Board Notice 194 of 2017 and amended by Board Notice 707 of 2020. This also does not include registered banks as defined in the Banks Act. Also registered insurers as defined in the Insurance Act. In terms of the new requirements, FSPs must ensure that assets exceed liabilities at all times and must maintain financial resources that are adequate to carry out their activities and meet their liabilities as they fall due. If an FSP collects premium, must have strategies or processes and systems and financial resources to cover its risk and exposures. FSPs may not become or continue as a FSP or juristic representative if they are declared insolvent or provisionally insolvent, or if they are placed under a liquidation. Thandi, unless if I've left something here, you can add on the requirements of Chapter 6 of Fit and Proper before we go into detail on.
Yes. Okay. So I think you've covered pretty much all the general requirements. However, the second thing where FSPs may not continue when they are insolvent, there are certain instances where FSPs may be exempted from being financially sound. And in that instance, they may be allowed to still operate as an FSP while under an exemption. However, there are conditions that apply, and FSPs must ensure that they meet those conditions in order not to have that exemption taken away from them and in order not to lose their license. So one of the new definitions that came in with the amendments is the definition of annual expenditure. And Fortune and I went into great lengths at discussing what constitutes annual expenditure. So when you look at annual expenditure, you need to think of the expenditure incurred in generating the income of the FSP. And that will be your capital expenditure, which is your capex. That will be your operational expenditure, which is your opex, as well as any interest on loans that you may incur, because this is interest that you are incurring in generating your income. What expenditure doesn't look at? It doesn't include staff bonuses. It doesn't include employees or directors share in profit. It doesn't include the emoluments to the directors or any other appropriation of profits. It doesn't even include a percentage of the FSP's revenue that needs to be allocated amongst members or partners or members or directors. It also doesn't include a percentage of the revenue generated by employees or representatives. It also excludes depreciation because that's a nominal cost. It's not a cost that you actually incur in generating income. Depreciation is merely a consumption, a reflection of the consumption of a capital asset. So where you have a capital asset, as you utilize this asset, this is reflected in the depreciation. So it's not, in fact, a true reflection of expenditure that is incurred in this year. The capital of expenditure would have incurred in a previous year. However, you realize the depreciation over the time that you will enjoy the benefits of this capital expenditure. Bad debts as well are a nominal expenditure. It is just a reflection of accounts receivable that you will no longer get paid out of. And that's why you would put that in your income statement, and that is not expenditure. It is something you are writing off because you are not seeing it as feasibly recovered. Any loss that results from a sale of assets does not constitute expenditure because it is a nominal loss. It is something that is calculated on the value of an asset, after minus whatever income you will derive from the sale of that asset, and that nominal loss does not constitute a liability. It does not constitute, expenditure. It is just a nominal loss that does not affect the entity's ability to generate income. I don't know if there's anything else you can add to what expenditure is, Fortune.
No, thank you. I think you have covered almost everything. So, yeah, thank you so much. We may continue. Okay, let me continue with cash. We tried to discuss what is cash, what cash is actually. So, at the end, cash is the banknotes, the reserve banknotes, and a coin. So if one wants to read about it, you are more than welcome to go into the, I think the Banks Act defined it in detail. So it will be advisable for anyone to go into the Banks Act and read cash. What does it mean when you say cash? So yeah, unless if there's anything, but cash is a banknote or a coin in short.
Yes, and any balance that is in a bank account that is easily liquid.
Okay. Yeah, thank you.
Right.
And then we'll move to, okay.
Sorry.
No, over to you, Thandi. You can.
Okay. When we look at remuneration, we look at the compensation or consideration that is given to any staff member, employee, representative, or contractor. So this includes salaries, wages, commission, and any fees paid for any services provided by any such persons. So it doesn't matter if this money is paid directly or indirectly by the FSP. If it is paid by the FSP in line with expenditure that derives the income of the entity, it is considered remuneration. I don't know if there's anything else that you can think of, Fortune, in line with that.
No, there is nothing. Remuneration is just a straight line answer. Remuneration is you remunerate someone that has delivered something on your behalf. So
Indeed.
That's it. That's how you will remunerate someone. So besides that, there is nothing more to add on. Okay, from the beginning, we talked about a solvency. So now we are going to deal with how the solvency calculation is applied. The solvency calculation is the solvency calculation for FSPs that do not collect the premium. It's a straight line calculation. It's total assets minus total liabilities. What is important is to know what entails or what is it that consists of in a total assets and the total liabilities. So what we are going to do is we will unpack the total assets. What do we mean when we say total assets? What is it that is included in a total assets or in a total liabilities, especially for FSPs that do not collect premium. So total assets for FSPs that do not collect premium, it's your properties, your vehicles, your goodwill is also included, your intangible assets, your loan to related parties. It forms part of the total assets. Take note that goodwill it is not excluded on the FSPs that does not collect premium. So forms part of the total assets. And total liabilities is all your non-current liabilities, your long-term liabilities and your current liabilities. When we talk about non-current liabilities, we were talking about the liabilities that are, let's say, your long-term one, let's say more than 12 months, the one that it's let's say you've got a loan that it's payable for more than 12 months. That one it will fall under
non-current.
Yeah, non-current under the long-term liabilities. And your current liabilities is liabilities that are payable within the period or within the period of 12 months, to be specific, or within the reporting period. So yeah, Cat 1 FSPs that do not collect premiums are required that must have an asset that are more than liabilities, and the assets must be of a good quality assets. To give you an example, what do we mean when we say good quality assets? Let me just ask Thandiwe regarding, let's say, a goodwill. A goodwill for an FSP with the name of, let's say, Fortune, and I decided to put a goodwill of 5 million under my total assets. Would you consider that as a good quality asset or what?
Okay, so Fortune, very, very, very important point there. When we look at the financials of Fortune FSP, we would check whether this goodwill of 5 million makes sense in line of what we know about Fortune as an FSP. So if Fortune is a small FSP, The rest of its assets are quite minimal. Its liabilities are standard, and its operations from its financial statements, financial income statement are also very low levels. However, you have a 5 million rand goodwill. It would not make sense to what the rest of your financials are telling us. So we would look at the quality of the rest of your financial statements, and if it doesn't make sense, we will inquire and ask for perhaps a valuation from an independent valuator on how you derive this goodwill. So we wouldn't take it at face value that this goodwill is accepted for an FSP that does not collect. It would still have to make sense when we go through your notes, the notes of your financial statements. You would have to show us that there is an acquisition that you have made as Fortune Fortune Ltd, perhaps, that validates this goodwill, and that you have valuated this goodwill at 5 million based on this particular, business venture or joint venture or acquisition that you've made, and you are foreseeing that you will realize this goodwill in your operations, perhaps in the next few years or in the next financial year. But if it's just goodwill that is planted there and there's nothing that substantiates the amount of goodwill that you have there, it would be very difficult for me to consider that goodwill Fortune as a good quality asset. So a good quality asset as well has to be in line with the rest of your entity, the rest of your balance sheet as well as financials. They would need to speak to each other.
Okay, thank you, Thandiwe. Okay, just to summarize this, on the left-hand side, you can see that we've got the balance sheet of ABC with total assets of, for 2020 financials, the total assets of 25,000, and the total liabilities of 8,000. So when you test the financial soundness requirement here for FSPs that do not collect premium, you just take the 25,000 and you minus it with the 8,000 of total liabilities. Then it will give you the net assets of 17,000. And for 2019, when you look at your total assets, it's 15,000 rand. And under your total liabilities, we have 16,000 rand. So here, when we look at it, you will take the total assets minus the total liabilities, of which your total liabilities are more than your total asset. So it means this FSP for 2019 financial does not meet the financial soundness requirements. Then here the FSP will be queried for maybe to give us an explanation why are they not meeting the financial soundness, and to provide us with the plan on how are they going to meet it. And yeah, so if the FSP were testing this on let's say the FSP were testing this on a month-to-month basis, they would have realized this and notified us on time, so that they are not meeting financial soundness requirements, but this is how they are going to rectify this contravention.
Indeed.
Yeah. Thank you. We'll move to the next slide. The next slides talk about FSPs that collect premiums. So what are the specific requirements on the FSPs that collect premium? The same solvency requirements applies in here. The only difference is that for the FSP that collects premiums now, the total assets and the total liabilities, the requirements differ on this one, and we will explain this in detail when we explaining them. I think when we do the annexure 6 form A, we will explain this in detail. But also there is an additional requirement that FSPs that collect the premium needs to meet. It's a working capital requirements where the current assets must exceed current liabilities. Liquidity requirements where the FSP is required to keep or to have a certain minimum amount or an amount that it's enough to cover the operating expenses. Here also we'll discuss it in detail when we discuss the Annexure 6 Form A. Also, the FSPs that collect premiums, they are required to submit audited report, of which it's section 19.2, and also and also submit an audited report for section 19.3. Section 19.3, the audit report will refer mostly to the separate bank account, the bank that they are collecting premium. So here also, just to make it clear, if an FSP feels like this section 19.3 is not applicable to it, so it can communicate it to the analyst that is responsible for it. So it is easy. If the FSP can log into our e-portal system, they should be able to see who's the analyst that is responsible for it, so they can ask questions to that analyst. Thandi, if there is anything that I might have left here, you can add.
Okay, Fortune. Thank you, Fortune. I think it is important to note that the section 19.3 requirement is quite, we are stating it generally, and that it would, what is required for different collecting FSPs would vary from FSP to FSP. And that's why Fortune now says specifically that you need to refer to your analyst for your FSP and just make sure what the correct form in place of the section 19.3 is for your particular FSP. Because especially for the short-term, for the FSPs that collect short-term premiums, there are a number of variations which we are not going to go into today. However, it is important to note that you need to make sure that you check with your analyst, as Fortune alluded earlier.
Okay, thank you, Thandi. Just to sum it up, the juristic representative of the FSPs also are required to submit the Annexure 6 Form A to their FSP. They don't submit it to the FSCA or to the authority. They submit it to their FSP. Just to make clear, the juristic representatives submit the Annexure 6 Form A to the FSP. It is the responsibility of the FSP to make sure that the juristic representative meet the requirements as required or as stipulated under the Board Notice 194 of 2017. So it is the responsibility of the FSP that they test the solvency of the juristic representative. Okay. Also, yeah, we there is an additional that it was added on the FSP that collect premium regarding the assets that must exceed, that the asset must exceed the liabilities by more than 10%. The current assets also must exceed the liabilities by more than 10%. If the asset does not exceed the liabilities by more than 10%, FSPs needs to notify the authority that they are triggering with this requirement. So the responsible analyst will be able to communicate with the FSP on what measures can be put in place to ensure that the FSP meets this requirement. Okay, this is Annexure 6 Form A. Thandi, you can take over the slides.
Okay. So the Annexure 6 Form A takes us through the liquidity of an institution. So you'll remember earlier, Fortune told us about the additional requirements that come for that are in place for a financial service provider that collects premiums. So in addition to the liquidity calculation, the assets of the institution are calculated differently. So we will look at your total assets as we had defined them earlier with Fortune, and we had said that your total assets, including your goodwill and so forth. In this instance, for an FSP that collects premiums, you will subtract any goodwill, you will subtract any intangible asset, you will subtract any investment in a related person or a loan to a related person from your assets as defined. And that is stipulated within the requirements of your fit and proper as an FSP that collects premiums. And then secondly, when we look at your liabilities, you will need to also, in the same manner that you have subtracted the loans to related persons, you will subtract any loan from a related person, be it an entity within the same group or the directors or members themselves that has been validly subordinated. So the fact that it is a loan to a member, if it is not subordinated, you cannot subtract it. You only subtract it if subordination is expressly noted on the particular loan from the member or director themselves. So Fortune, we can move to the next slide. So when we look at the liquidity requirement, we also look at the working capital, meaning your current assets less your current liabilities. And again, as Fortune explained, there's a threshold of 10% that the current assets still need to exceed your current liabilities by 10% to ensure that you are always able to meet your current liabilities. That there is no threat to you as an FSP meeting your current liabilities. And then we look at the Annexure 6A form. When you populate it, this is what you will see. We look at your liquid assets and then we will list your expenditure. So when we look at your liquid assets, we look at your cash, your immediately available cash in cash and notes, as well as any cash in a bank account or like that is easily converted without any penalty into cash within 7 days. So money that you can access within 7 days, and any cash that can easily be converted without any penalty on the capital into cash within 30 days. So that would speak to your 32-day accounts and investments and things like that. We would also look at any investment in a money market investment that can be converted within 7 days as well as within 30 days. And then another element we would look at is 70% of any market value or security listed on a licensed exchange, provided that it does not constitute more than 50% of the liquid assets. So if this total market value of the security is not more than 50% of the total liquid assets, you can add it to the liquidity calculation. And when we look at the expenditure, as we defined expenditure earlier, it will be your total expenditure, meaning your CapEx, your capital expenditure, your operational expenditure, including sales costs, meaning your cost of sales in instances where the FSP has sales, as well as finance costs and operational costs. So it will also include your commission fees. It will also include any other expenditure that you would incur in line with generating the income of the FSP. Then we go back to the definition. We will minus the staff bonuses because these are above the line. They are not expenses that are incurred in line with generating more income. These are just nominal and not in line with increasing the operational requirements of the entity. We will minus any employees or directors share in a profit. We will minus any emoluments to the directors, members or partners or the sole proprietor. And then we will list any appropriation of profits to directors, members or partners, and we will minus any remuneration that is linked to a percentage of the FSP's revenue or a percentage of the revenue generated by an employee, a representative, or a contractor of the FSP. Provided that in the absence of such revenue, the FSP has no obligation to pay the remuneration. So if any service is incurred by any of the persons are mentioned, any employee, representative, or contractor is incurred, but there is no obligation to pay those people, you less that. And an example of that would be a bonus or an incentive that is paid out to an employee and like. We would also minus the depreciation of the FSP because this is a nominal expense. It is merely a reflection of the consumption of a capital expenditure. So a capital expenditure would be something like your vehicle, equipment, or property that is any type of property that is being depreciated over time. And I'm not referring to property in the sense of land because you do not depreciate that. We would look at any property and equipment that is depreciatable. That depreciation does not form a part of the expenditure because that is merely just the reflection of consumption of previously incurred expenditure. Then we would look at bad debt. Bad debt is just a write-off of any asset that you feel is not realizable. So if you have an accounts receivable where you see the client has gone bad or is insolvent and you will no longer realize that value out of that asset, you will write it off. But it does not affect your operational requirements. It does not affect your ability to generate the income, and that's why you will subtract it. You will also subtract any loss from the sale of assets because, again, this is a nominal loss. It is not anything that is affecting any of your operations that lead to you generating your income. At the end of that, we will look at the cash, then less the total annual expenditure. We will get to what your liquid assets are, and then we would then divide that by 52 weeks. That looks at by 52 weeks, which helps us see if on a weekly basis the entity can meet its liquidity requirements. So on a weekly basis, is the entity able to meet its current liabilities and obligations of the entity? And then at the end, you need to, as an FSP that collects, sign the declaration that says that all the information that is there is correct, as you know it, nothing is fabricated, that you are assured that you can meet the liquidity requirements of the Act. Fortune, I don't know if there's anything else that you can think of that you can add to that.
No, you have covered everything, Thandiwe. Thank you so much.
Thank you, Fortune.
Our next slide is what happens if a financial soundness exemption is granted to the FSP. If a financial soundness exemption is granted to an FSP, it means the authority has allowed the FSP to continue trading while it is not financially sound. So we know that the FSP are required to be financially sound on an ongoing basis. So if an FSP is not financially sound, the FSP has got an option to apply for a financial soundness exemption, and it is the discretion of the authority to grant the exemption or decline it. And there is a financial expenses that need to be covered when you apply for an exemption. However, it's not like all the FSPs that are applying will be required to pay financial whatsoever. We look at case by case. Some FSPs, you will say that no, these ones, they've got valid reasons that why they are not able to pay the required amount that needs to pay when they apply for a financial exemption. Those FSPs will be allowed, or we will entertain the application. So FSP is expected to comply with the exemption conditions that will have been imposed on them when they applied for the exemption. And also FSP are required to communicate any matter that may impact on its ability to comply with the exemption. And FSPs are required to notify the authority of any change to the particulars relating to its application for the exemption. So let's give it an example. Let's say an FSP as on their application, they've mentioned that on a 6 month basis, they will be able to retain a minimum amount of, let's say, 1 million. And they realized that, oh, we are not going to meet or to comply with the exemptions conditions that we were given. So they will have to notify the authority on time that, look, this is the situation. We are not able to meet the exemption requirement, and this is how we are going to rectify the situation. So yeah, Thandi, unless if there is something else that you would like to add on.
No, indeed, indeed, Fortune. I think really it's just to add to what you said, that a lot of it has to be open communication. So as and when something changes, if you know that it's going to be 800 that you now meet instead of the 1 million, communicate it, and the analyst who's working with the case can then assist you in how you move forward with you not being able to meet this requirement. Because remember, if you do not meet it at the time that you have stipulated, if you do not meet any of the conditions, it lapses. So when you have informed us in time, then it's easy for an analyst to advise on what can be done in that instance. And I think you've pretty much touched on everything else, Fortune, that everything that they do would have to be in line with the remedial requirements that they have submitted. Again, they have to remember as FSPs that they need to remain compliant with all the other requirements of the Act, as well as of the Act. They cannot be suspended. They cannot have their license withdrawn. They cannot, for instance, not pay their levies. They cannot not submit their financial statements because they have an exemption that's perhaps standing for 2 years or 3 years. Within that period, they still need to make sure that all their Fais requirements are adhered to as an FSP, that they do not fall short with any of their other requirements.
Thank you, Thandi. Most importantly, the last bulletin, the exemption automatically lapses where FSP fails to comply with any condition. So, yeah, if the FSP fail to comply with any condition, the exemption will automatically fail, will automatically lapse, and the FSP will be referred for regulatory action. So the FSP is required to adhere to the conditions that would have been imposed on them. So if they don't, the exemption automatically lapses. So there is no more communication from us. What we do is we will refer the FSP for regulatory action.
Indeed.
Thank you. And this is the end of our presentation. And on my side, I think we have covered almost everything. And it's over to you, Thandi. If you have anything to add on.
Thank you so much, Fortune. From my side, we appreciate the opportunity to be able to just have a conversation with the industry, to just give them a bit of light on the changes that have taken effect on the board notice, and that should they have any questions, they can consult with us as analysts, with their respective analysts for their FSPs, if they have any questions in line with what the changes mean to their entity and how they need to stay compliant with the provisions of the Act as well as the board notice. And thank you so much, Fortune, for the conversation and for engaging me.
Thank you. Goodbye.